Hello and welcome to Simply Tax. It's Thursday, October 21, 2021, and today I'm looking forward to a follow-up conversation with one of our early guests on the podcast on a popular but also frequently overlooked or perhaps just underestimated planning opportunity to exclude gains on certain small business stock. In early May 2018, I had the opportunity to explore Section 1202 after the enactment of 2017 tax reform with guest Rick Klahsen in episode 26 of the podcast, which, by the way, I would encourage you to pause this episode now and give it a listen if you haven't already, or if you'd like a little refresher. With tax reform back in the headlines and a specific proposal targeted at curtailing this meaningful exclusion, it's an honor to invite Rick back to the podcast to have a follow-up conversation to see how the Tax Cuts and Jobs Act impacted the prevalence of Section 1202 planning, and to discuss how the current proposals might play out if enacted as currently written. Now, before we get to Section 1202, I couldn't pass up the opportunity with someone so successful and insightful as Rick to ask a favorite question I often like to ask those who are much wiser and more experienced than I am. If you were to go back and tell yourself something on the first day working in public accounting, what would that be?
I think it probably has two aspects to it. I would encourage myself to keep an open mind and to take a longer-term view. I think sometimes we, at least in the early stages of our career, we have an idea, a specific sense of what we think we want to do or how we want to do it. Things change. When I look back at my career, there's a lot of varied aspects to it that were certainly much, much different than I would have anticipated early on. So keeping an open mind. And again, taking that long-term view, because I think sometimes if we are a bit too short-sighted, we might make decisions about our career, about the opportunities we want to pursue or don't want to pursue. I think sometimes it would be disadvantageous to us. We would have benefited from a bit of a longer-term view about that.
Great stuff, Rick. That absolutely is. It's the hardest thing to know in the moment, but the best perspective to have for sure. And maybe that gets us a little bit over into our 1202 conversation here, in terms of kind of taking a long-term view sometimes on things. But before we get to it, we kind of started off the podcast early on talking about cocktail party conversations, because tax topics are always a hit at cocktail parties, right?
Right.
So I guess if you and I were at a cocktail party right now, and the subject of 1202 came up, how would you describe Section 1202?
1202 is a provision of the Internal Revenue Code that was enacted to encourage startup and entrepreneurial investment in certain types of businesses, trader businesses, organized specifically as C corporations, under which if you're willing to hold your investment for a minimum of 5 years or more, you have the potential to exclude a significant portion of your gain from that investment, perhaps all of your gain from that investment, from federal income tax.
Anytime you start talking about excluding gain from income tax, I know my ears always perk up. I find that many others do as well, at the prospect of that. So I guess I'll say I know from our conversations and working together on it, right, that maybe there are some challenges there, that maybe some hoops to jump through when you're planning with qualified business stock. What would you say a few of those are?
A couple of them come to mind. You have to be the recipient of the C Corp stock upon its original issue. Now, that doesn't mean you have to get the stock when the entity was initially created, but you have to be the person that first received the stock issue from the corporation, meaning there are restrictions around transfer of that stock. You can't sell it to a second person. They wouldn't be able to qualify. I mean, you obviously could sell it to them, but their investment would no longer qualify. Now, you can make transfers by gift or bequest or under other certain circumstances, but it's the fact that there's restrictions around how you receive the stock in order for you to qualify. I think the other thing that mechanically within 1202 is probably one of the biggest challenges or one of the biggest traps is the provisions that discuss redemptions. There are rules around redemptions. If you're, as to a specific shareholder, if your stock, any of your stock or the stock of a person related to you, was redeemed in the 2-year period before you receive another issuance, or redeemed in the 2-year period after you received an issuance, then you potentially have disqualified your issuance from 1202 eligibility. That rule is expanded in the sense that it can apply to any shareholder, but then our redemption period is only a 1-year look back and a 1-year forward-looking period. But you can potentially have redemptions of another party's stock that cause the disqualification of your stock, and you might not even be aware of it. And so it's really, really important to work through those redemption provisions, make sure that people that are considering making an investment understand them, and if possible, to put provisions in the agreement that basically put restrictions around, borders around when and how redemptions can be undertaken by the corporation so as not to cause people to lose the qualification of their stock.
It's sort of one of those things you have to care, feed, and water, right? And you can inadvertently trigger something there that would cause a problem down the road. With thinking that way and protecting, I guess, this classification, how would somebody know? What's the approach that you see many people do to make sure if they have that provision, they're sticking with it, but even if they don't, are kind of protecting the 1202 characteristic here?
Yeah, that's a challenge because as an individual shareholder, you may not necessarily know that someone has been or is requesting redemption of their respective stock. Certainly, if you're making an investment in an existing 1202 qualified entity and you're expecting that your stock will also be 1202 qualified, or it's been represented to you that it is, one of the things you would want to get very clear representation on is that there have been no redemptions in the period of time prior to your investment. And you would want to be sure that you're confident in those representations. I think secondarily, if you're looking to make an investment, whether you're one of the startup investors or a subsequent investor, it's also getting clear representations in your agreements that there will be no redemptions for a specified period of time. That can be a bit of a challenge to accomplish because obviously other shareholders might expect that they have a right to redemption for certain purposes. But if you're looking to make sure your stock is qualified, you need to really tighten up those redemption provisions when you're making your investment.
Minding the details here is so important. So again, those are maybe some of the challenges, the things to look for there. But when we just look at this opportunity, again, ears perk up whenever you talk about exclusion from tax, exclusion of the gain. What are some of the planning ideas that you've seen in utilizing 1202 that have been particularly effective?
I think one of the areas that's been really interesting is to watch the interest that's taken place over the past several years in the private equity space, specifically structuring acquisitions to qualify, or we've seen other instances where people have worked to convert existing entities into C corporation, into a C corporation that will be or become 1202 qualified. I think those have been the areas that I've found the most intriguing. Is you have to go through some specific steps to accomplish conversions of existing entities into 1202 qualified businesses. And in the private equity space, there's often a lot of, I don't know what I want to call it. There's a lot of steps. There's, different investment types and investment levels. And the multiple parties sometimes have differing objectives. And to work yourself into something that is 1202 qualified, that everybody understands is 1202 qualified, it maybe accepts that it is, or accepts that their investment won't be qualified, it makes for a really, really interesting analysis and discussion. There's a lot of opportunity there, but it does take a fair amount of discussion, planning, and research to make sure that you can get yourself to the point where everybody understands they are now qualified and what the consequences or what the opportunities are and what the consequences could be on a go-forward basis by making additional investments or seeing the business grow.
I'm glad you mentioned the private equity space because, I've seen a lot of interest in that. And it almost seems like an approach that's taken. Either you're going for 1202 or you're not. Maybe could you unpack that a little bit as to maybe why? And I guess maybe probably hard to say, kind of even percentage, and we'll just say maybe in your experience that you see kind of go that direction versus maybe the not qualified small business stock direction?
I think without a doubt, there has been much more interest in 1202 in recent years, driven perhaps by, it seems to be two factors. C corporations are historically tax inefficient, right? They have two levels of taxation generally. And oftentimes that math was not in the favor of having an entity organized as a C Corp. Well, with the enactment of the flat 21% corporate tax rate, I think all of a sudden there was an increased interest in C corporations because people felt like, well, I can pay a lesser tax than I'm going to pay in the S Corp setting perhaps, or the partnership setting, and I can manage or defer to a certain point in time the realization of that second layer of tax that causes C Corps to be inefficient. So I think because of that reduction in the tax rate, people started to look more closely at, well, could I or should I be a C corporation? And I think the other thing that drew people's attention to this in a very, I guess, roundabout way was the enactment of the qualified business income deduction, which doesn't have application to C corporations, but the definitions used for the businesses that will qualify for that qualified business income deduction was derived from 1202 with a few exceptions, a few nuances. But that drew people's attention also to 1202. And I think as entrepreneurs and investors started looking at that with their advisors, I think those two factors piqued everybody's interest. And certainly that was the case with private equity. And now what we see a lot of, or I see a lot of, is the private equity firms structure their investments as, if possible, to be 1202 qualified, but understanding that they may not hold that investment for the full 5-year holding period. But they've positioned themselves in a way that they view as be most favorable to them, in the sense that, well, if I hold this investment long enough, I qualify for the 1202 exclusion, and again, resulting tax benefits from that. But alternatively, maybe somebody comes along and makes me a very, very favorable offer in the period of time before I qualified for 1202. And I think they just feel like they've positioned themselves to be as well informed about when to pull that trigger on taking the opportunity to realize their investment. They either know that they're going to make it to 1202 and realize those benefits, or they know that they've got a really good deal that, even though they're not going to qualify for 1202, is economically still more favorable and acceptable to them. So I think those are a combination of factors that have really started or caused 1202 to become much more, I'll say, relevant in the past 2 to 5 years. It's been around for years.
Right.
It was always available, those kind of things. And if you qualify, it's not elective. But it's certainly, I don't think it's gotten as much attention as it's gotten in the recent 2 to 5 years.
You mentioned too that obviously kind of having this flexibility, but as much as you and I love tax planning ideas and seeing them come to fruition, sometimes there's the business or the investment side and the opportunity. You kind of have to weigh those two things. I know there is a section 1045. Maybe we can unpack that a little bit and how that might factor into some of the 1202 planning here.
Yeah, I probably already alluded to the fact that 1202 it's been around for a while, but it was seemingly ignored, or relatively ignored, for a period of time. Now I feel like 1045 has kind of stepped into that position and has been out there for a number of years, but is not something you see a lot of activity with. 1045 is a parallel provision that allows you to potentially defer gain recognition for your otherwise 1202 qualified stock if you don't meet the holding period. Let me explain a little bit further. If you have held 1202 stock for a minimum of 6 months, but you haven't yet held it for 5 years, and you sell that stock, you're going to have regular capital gains, okay? Well, 1045 would allow you to defer that gain so long as you're willing to make an investment in another 1202 qualified entity. It's basically a rollover provision. In the same way, can have a lot of power and impact because your holding period from the first investment tax on, so you don't have to start the clock all over. And it allows you to potentially realize the benefits of your initial investment by simply making a second investment and waiting. You got to wait to realize on the second investment, but it's the possibility of getting to what you thought you were getting when you made your initial investment. Now, the challenge is it's got a very narrow window of opportunity. You have to make the investment in that second 1202 qualified small business within 60 days of the time that you realize the proceeds from the first sale. So to do that, you have to be on the front end of things. It requires attentiveness. It requires planning, knowing that there's discussions about your first investment being sold. You really have to start that process almost at the first moment you hear about that possibility to start to look for and identify another 1202 qualified business in which you can make your investment.
So how do you see people that, I guess, become aware of this, manage that? Like you said, having the conversation on the front end, but I mean, is it even going as far as to kind of having an eye on maybe other opportunities and kind of looking at that way? Or how do you approach that?
Yeah, I have assisted a couple of people in 1045 planning opportunities over the past couple of years, and surprisingly so. Now, these were savvy investors who had made investments multiple times, but they were able to find connections and informations where the other 1202 eligible companies were identified, and they understood or knew that those companies were receptive to additional investments. And I gather that there's information out on, in social media and the web and whatnot that apparently allows people to look for and identify these entities, because I've been surprised how the people that were attentive to this opportunity didn't necessarily have difficulty finding that replacement investment. So there's more information out there than one might expect, but you do have to be working it and be attentive to it and spend some time to find it and identify it.
You mentioned this a little earlier, the qualified business income deduction. So I'm going to imagine that's going to factor in here. But as you know, and it's kind of hard to believe it's been a number of years here, Rick, but we sat down right after the enactment of the Tax Cuts and Jobs Act, and we were talking about 1202 in an episode of the podcast. And as we wrapped up that conversation, I don't know if you remember, but I'd asked you if you thought there was going to be more interest in 1202 after tax reform. So I guess with the QBI conversation in mind and all of that, how would you answer that question, I guess, as of right now?
Well, certainly there has been more interest. And I guess the question would be, are there things that would suggest that the interest will continue? And I think the answer to that is certainly yes. Maybe going back to just some of the earlier comments in this discussion, when you asked me about my cocktail party conversation and I said something about the opportunity to maybe fully exclude your gain from federal taxation, you said your ears perked up. Well, that's understandable because there aren't a lot of provisions available that would allow you to do that, right? And so this is one of those opportunities that remains, and I think the interest level is going to continue with some qualification, though. There's been discussion in Washington of increased corporate tax rates. That might have the effect of dampening the interest in 1202, again, because of the inherent inefficiency of C Corps. However, there's another discussion about raising capital gains rates. And I think that would only encourage and enhance interest in 1202, because if my regular capital gain rate is going to go up, but 1202 allows me the opportunity to potentially exclude my gain from taxation, then that to me would suggest I have an even greater interest in 1202 related investment opportunities, because now the potential savings is that much greater, that much increased. So I think there's an interesting couple of factors that are going on in Washington and the discussions. The one thing I should point out, and I get asked this question sometimes, is about, is Section 1202 at risk? I mean, it obviously would be a means of raising revenue, right? If you were to repeal 1202.
Now, that's a great question to ask. And prior to the release of the proposals from House Democrats on September 13, 2021, Rick and I both would have told you there really weren't many discussing a possible scaling back of the Section 1202 exclusion, perhaps largely since it wasn't included in President Biden's proposals. However, as you may have heard at the start of this episode, there was in fact a little something in there for 1202 beyond the rate changes that Rick just mentioned that was added to the legislative text that was later approved by the House Ways and Means Committee on September 15, 2021. Of course, the outlook is uncertain and anything is possible at this stage of the legislative process, as we've discussed in previous episodes of the podcast. But if enacted, this change would limit the exclusion on qualified small business stock for taxpayers with adjusted gross incomes of $400,000 or more, or any estate or trust. Under the proposed provision, the special 75% and 100% exclusion rates, which were added to enhance the provision and designed to make investing in certain small businesses more appealing, would not be available to taxpayers over the threshold. However, the baseline 50% exclusion would remain available to all taxpayers. The amendments made by the section are proposed to apply to sales and exchanges after September 13, 2021, subject to a binding contract exception. Let's get back to Rick to hear what this change for 1202 might mean for you.
Despite that somewhat uncertainty, I would think the interest in 1202 and structuring your investments to qualify, I would advise investors to do that if there is the possibility, simply because you're positioning yourself for a very favorable potential benefit if 1202 continues and your investment ultimately qualifies under the holding period. But what I'm suggesting is I still think, despite the uncertainty around some of those things in Washington, I think positioning yourself for potential 1202 benefits is something that to me still makes a lot of sense in many cases.
With that in mind, if you are somebody that's looking to do that either as an investor or someone structuring the deal, would you say there are some maybe key things to be asking about on the front end, or maybe the second part of this question, I'll make it a two-parter, how would you go about making sure that you're on the right track?
Well, I think, first of all, you really have to analyze the type of business that you're investing in, right? Because not all business types, if you will, or business activities qualify, right? 1202 is interesting in that it doesn't define what is a qualified business. It defines what isn't. But you do really want to test that and make sure that your investment opportunity is something that you are confident will qualify for 1202 provisions. You also want to give some consideration to the size of the investment because there are some restrictions around business has to be considered small for 1202 purposes, and that means there's a $50 million gross asset test. So sometimes people need to be careful about if there's an existing entity that they're going to make an incremental investment in, they need to be sure that the business isn't going to cross that $50 million threshold by virtue of their investment, because that's problematic. In fact, you wouldn't qualify if that were to happen. It just requires a lot of planning on the front end. 1202 has its nooks and crannies. Like I said, it's been around since 93, and while it's not an extremely long code section, it's got a lot of nuances to it. And the challenge to that is there's not a lot of peripheral information, guidance, rulings, regulations around it. So you're left with looking at the code and discerning the code provisions. And as you well know, sometimes code sections are less than artfully written.
They often are, which I guess sometimes can be frustrating, but at the same time, interesting and things to kind of go down and explore, which it still is probably interesting, right? The fact that 1202 came about in 1993 and we still kind of have areas that we just really don't have great guidance on, to your point. It seems almost kind of surprising probably to some people, I would imagine. I don't know, as you're having those conversations with those you've worked with, do they find that to be surprising when you're getting into those nuanced gray areas perhaps?
Yeah, I do come across that occasionally where people will say, well, what about court cases? Precious few. What about regulations? Not much. What about other rulings? Again, limited number. What almost is some of the best guidance you'll find is written commentaries by other advisors. I mean, this is a subject area that has some level of written commentary on it. and some of them are helpful, at least, for purposes of comparing and contrasting another advisor's thoughts and conclusions against your own. Obviously, they're not authoritative, but you'll find, I think, when you start to dig around in certain aspects of 1202 and 1202 planning, that the best information you're perhaps going to get is just a collection of written commentaries from people who work in the area, and precious little that one would consider truly authoritative guidance.
Rick, you're kind of maybe bringing this conversation full circle, maybe some thoughts that you would leave people with, or maybe some areas even that we haven't quite gone down that you think should be part of the conversation.
I guess it's probably something I've already repeated, and it almost ties back to one of the initial questions you asked me about what would, if I were to step back to the first day that I started working in public accounting, what would my advice be? And one of my comments was to keep an open mind. I think that's the case when it comes to investing and planning for those investments. I think it's very important that as an investor and an advisor, you keep an open mind. C corps have a historic taint because of the double taxation structure, and that still exists. But with 1202 in place, you can overcome that if circumstances are right, planning is right, all of those kind of things. And so it presents a very viable alternative to the different investment scenarios that you could undertake and structuring scenarios. And I would just encourage people to take a real strong look at 1202 and its provisions. It's not for everybody. Trust me, I get that. There are things that are advantageous in the partnership context. There are perhaps things that are still advantageous in the S Corp context compared to C Corps. But I think it certainly is worthy of the investors and the planners' consideration.
Good connection or correlation you made there between the two, because I think what's perhaps so fascinating to me in particular about 1202 is there aren't necessarily right and wrong answers on how to do it, right? And you're kind of balancing these considerations of flexibility perhaps against the tax savings, against you name it, right? All the different factors and criteria. I mean, it's very similar to managing your day and managing your career and the intersection of the personal and the professional, all that. So that's a really great point there, Rick, that I don't think I'd ever connected those dots on before.
Yeah, and I think the other thing I would mention is, there are ways of transitioning an existing entity into 1202 qualification, partnerships, for example. That can be accomplished, requires some obvious planning and understanding of what you need to do to accomplish that. Transitioning an S Corp into that setting is a little more challenging, but also can be done. Yeah, this isn't something that only should be considered when it comes to investing in a newly created entity. It might present an opportunity for certain investors that are already invested in an existing partnership or subchapter S corporation.
I feel like I'm a record over here, Rick, but another great point. And particularly perhaps, I know you mentioned some of the things on the horizon here, perhaps from a tax change perspective, and maybe some of the pay for the Build Back Better agenda of the Biden administration. And, taking another look at that C versus S and the 1202, and even with existing entities, not that it's necessarily that easy road to hoe, like you mentioned, but getting that all back on the table, revisiting that and seeing maybe how some of these potential changes, if enacted, maybe change the algebra a little bit.
Oh, I completely agree. That's the challenge of what we do, right? Is trying to anticipate what might happen and working your current opportunities against that. I guess it means you can't look for precision. You just have to look for opportunity.
So, is 1202 through? Is it for you? Let us know what you think by dropping us an email at simplytax@bkd.com or find me out on social media to let me know. I'm on LinkedIn and out on Twitter at Damien Martin CPA. You'll also find me on Instagram at TaxDad and on YouTube by subscribing to our Simply Tax YouTube channel. And finally, you can find additional resources and get the contact information and more on Rick in the show notes available this episode at bkd.com/simplytax. I'm Damien Martin. Thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. The Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.